Welcome to the Real Talk Retirement Show, where we explore the financial side of retirement and beyond. Whether you're currently retired or planning for the future, we offer real, relatable conversations about money and personal finances. Most importantly, we dive into all these topics using real talk. Now, let's get real about your money and your retirement.
Welcome, everyone, to episode number 12 of the Real Talk Retirement Show. We are Brian Graff and Tracy Burke from Conrad, Siegel. And Tracy, for the final episode of the year, we thought we'd have a little fun today and look at some financial statistics that at least you and I found to be quite interesting. Some of them may be quirky, some may be disturbing, and some may be even inspirational. And we're really going to do our best to relate it to best practices, though, as we continue our quest of providing educational content to our listeners that we really hope helps you in your financial journey. But I think we have a fun one today.
I absolutely, and I've been looking forward to this one in particular, Brian. And I think everybody's going to find this pretty intriguing. So, we have five different, sort of unique statistics. Plus, we threw in a bonus one. Five sounded better than six, right? When you're putting
Right.
out a number out there. So, we're just going to go ahead and jump right into the first one. So, this first one, Brian, if you invested $1,000 into Apple stock in its initial public offering back in 1980, what do you think the value of your Apple holding would be at this point? So $1,000 invested back in
$1,000 in
1980.
Apple. I'm not sure, Tracy. I think it's a lot of money and definitely more than I probably have in my wallet right now.
I would think that's the answer, and if not, just keep a hand on your wallet
Right.
because you would have roughly $2.5 million
Wow. Yeah.
worth of stock right now if you bought $1,000 of Apple at the outset, in the initial
Mm.
public offering. That's assuming you reinvested dividends. But the point is that there's a lot of people that are out there that are looking for that next Apple. And of course, we would love to stumble upon that, right?
Oh, yeah.
But I would venture to say it's likely more about luck than skill, right? And
Mhm.
many will end up investing in a very disjointed manner if you're thinking, well, all right, this, ABC company or XYZ company, hopefully that's that next Apple stock, and you buy a little, and it just doesn't go anywhere. So,
Yeah.
Brian, any thoughts on a maybe a better approach than looking for that next Apple?
Yeah, I'm not that lucky, Tracy. I'm not going to find the next Apple, and I know that. So, what I would recommend doing is to, within your retirement portfolio, diversify, right? Spread your money out, use dollar cost averaging, utilize low cost investments, focus on the long term instead of trying to hit the next grand slam, right? When you do that, you'll still end up owning the next Apple in your portfolio, albeit a much smaller and more reasonable slice. Okay, so that would be my recommendation is unless you're just really, really, really lucky in everything in life, use some of those time-tested strategies.
Absolutely.
Number two, as far as a interesting thing to look at today, Tracy, is we're going to examine playing the lottery versus the stock market. Did you know that the odds of winning the Powerball jackpot is roughly 1 in 292 million?
Not very good odds, huh?
So you're saying there's a chance, right? Yeah, but history tells us that doubling your money though in the stock market and just kind of using the S&P 500 index as a proxy, that usually does happen every 7 to 9 years, doubling your money in the market, assuming about an average annual rate of 8 to 10%. Now, those aren't bad odds.
Yeah, for sure. And if we think about the winning the lotto, that's a sudden type of an experience, right? And that's that sort of get rich quick sensation, and often why people play the lotto. Hey, I can be a billionaire, gazillionaire, whatever the lotto's at, in the next 2 days. That can be captivating. But successfully navigating the stock market, on the other hand, it's not a get rich quick, sensation, right? That requires patience and discipline. And I would just say that patience beats luck over 99% of the time. And again, it's not sudden wealth, it's discipline. But when you're playing the stock market, again, that's the best way to build wealth over time. And if we think about the odds of success, So, if I go play the lotto, the chances of me winning, especially winning something substantial,
Hmm.
extremely small, right? Most people go into that experience thinking or knowing that they're just tossing money away, just for that small little chance. But most people lose all of their money when playing the lotto. I would argue if we're investing properly, everybody should have a positive experience over the long term. Again, if you practice that patience and discipline. What do you think, Brian?
Yeah, absolutely. And I think the key takeaway here is instead of playing the lotto on a regular basis, consider putting that same money into a regular investment strategy. I know maybe it's not quite as much thrilling in the short term, but use that dollar cost averaging approach, keep buying into the market, at different periodic intervals of time, and you really will thank yourself later for having done that. I promise.
Yeah.
So third thing we're going to look at today is what we're going to classify as weird investments, Tracy. So as we approach the holidays here, perhaps the next one can stimulate some gift ideas. If you're struggling to find the perfect gift for your wife, Tracy, for example.
Okay.
Okay,
Okay.
so here, stay with me. So in 2020, someone who remains anonymous, believe it or not, paid $560,000 for a pair of game-worn sneakers of Michael Jordan.
Hmm.
$560,000 for used shoes, okay? Then in this past July, it's 2025, someone spent $10 million. $10 million. Okay, it was actually 8.6 million euros, which converts to 10 million US dollars on an Hermes handbag. I hope I said that right. Hermes handbag at an auction in Paris. I don't know exactly what that is, an Hermes handbag, but it sure sounds expensive.
Well, Brian, I'm impressed that you can pronounce Hermes correctly. That's awesome.
Did I though? Are you sure? Okay.
Yeah, I
Okay.
think you got it.
Okay, good. Good.
And on that topic, I have a coworker that I think maybe the lifetime spending budget on shoes has been that $560,000 that you've had there.
Yeah.
She always seems to be wearing new shoes
Yeah.
all the time. But anyways, luckily for me, for in terms of my shopping for holidays for my wife, she normally puts together a wish list. So
Yep.
I take a look at the list. I always ignore like the most expensive light items on the list. I cross those
Right.
out and I focus on the lowest cost items. I sort it by cost. So I guess what can I say? Husband of the Year award, right?
Yeah, I don't know. I think I might have you beat though, Tracy. 1 year earlier in our marriage, I bought my wife a vacuum cleaner for Valentine's Day.
Oh
We
no.
we needed one. We really did. It just happened to be February. I thought it was kind of funny. She was not amused. She was not amused at all. Lesson was learned. Never did that again. So anyway, back to the $500,000 sneakers and $10 million handbag.
Yeah. So of course, naturally that sounds extreme to most of us, right? And can sound crazy to the average person. But, some ultra wealthy people do crazy purchases, often because of the status or the uniqueness, right? They want to be
Hmm.
seen with these items or able to be bragging about
Oh
them,
yeah.
right? But then, the other thing that I always think about, wealth is also pretty relative. So
Hmm.
just say in some dream world, I'm worth $500 million. If I would spend 1/10 of 1% on those sneakers that we
Hmm.
talked about, roughly $500,000, it doesn't sound all that extreme. 1/10 of 1%, right?
Yeah.
But then on the other hand, if I have $1 million and I spend 500 plus $1,000 on a pair of sneakers, over 50% of my assets, that just doesn't make a lot of sense, right?
Little bit excessive there. Yeah, I would say.
Yeah, a little bit. So I think it is all relative, but I would say that the important thing to keep in mind is that it's important to live within your own means, right? And
Hmm.
we hear that a lot. Just be rational with the spending, and just make sure it fits into your overall financial plan.
Yeah, so the next fun stat we're going to look at is the cost of everyday items. So here's the part of the episode where we turn back the clock and we talk about how much things used to cost and how outrageous the cost is now. So, I can hear these conversations playing out in my head in retirement communities throughout the country at this very moment. Back in my day. But bear with me. I digress. So if you look at the average price of a house back in 1970, It was about $23,000. That's right, the full house, not
Yeah.
just the kitchen. $23,000. Now that same house might cost about $450,000, a 5.58% annual increase. Then we'll look at a gallon of gas back in 1970. 36 cents. Can you imagine that? Now,
Mm.
we're depending where you are in the country, it could be as high as $3.50 or $3.75, even more, I'm sure, in certain places. So that's about a 4.35% annualized increase. So, Tracy, what do you make of these numbers? While both examples are above long-term inflation trends, are those increases outrageous to you?
Well, if we think about it, the average price of the house, as you mentioned, and that was a 5.5% annualized increase. It certainly seems high over these past 55 years. But I think the other thing we have to think about is what you're buying. The terminology average really means. The average
Hmm.
size of homes have also increased significantly. In 1970, the data shows that the average size of a home in the US was 1,500 square feet. Today, it's over 2,000 square feet.
Sure.
So, if looking at cost increases per square foot, the higher cost of today's home, inflation adjusted, doesn't seem as bad. So, some of these things are in context. Gas, that one is a little bit, easier comparison, right? You're talking about a
Hmm.
gallon is the same measurement there.
Yeah.
But that fluctuates dramatically and certainly will continue to do so. So you mentioned the word inflation, Brian, right? And I think, here's what's important. Inflation is absolutely real. And I think, most of our listeners would agree, especially in recent years, going to the grocery store or other things. And
Yeah, we
it's
all feel
certain,
it. We all
yeah,
feel it. Hmm.
and it definitely clearly, impacts or affects our purchasing power over time. So, what's the best way if we think about, well, how can we combat inflation from an investment perspective and focusing on our investment portfolio? Is the inclusion of equities, and equities meaning stocks, right? Stocks over the long term, expected long-term return somewhere in that 8 to 10% range. And that certainly should outpace inflation by, several percentage points and
Hmm.
also help us, continue to build and compound that future growth within the portfolio. Now, we also know that some people, especially as you get further along in life, some people like to sit on a lot of cash, right? And the
Yeah.
return on cash almost always lags inflation. And bonds, sometimes it's tough to get excited about the return on bonds because that typically maybe exceeds inflation by a little bit over longer periods. And by no, means, Brian, am I trying to say that you shouldn't have cash or you shouldn't have bonds. It's important to
Sure.
have cash for that rainy day fund and your everyday needs, but it's not a good long-term investment vehicle there. On the other side of the coin, it doesn't mean you should be 100% in equities either. But some balance of equities, bonds, cash generally makes the most sense for folks.
Yeah, I was just going to throw in that same word balance, Tracy. Just like everything else in life, it's all about balance, right?
Yeah, absolutely.
All right, so we got to number five here in terms of some statistics to look at. And we are going to now focus on stock market milestones. So, just a few stock market milestone stats to throw at you. The Tracy, do you know the largest single day point gain in the Dow was 2963 back in April of 2025, very recently after the recent tariff announcement, which is about a 7.9% gain that day. However, historically, the largest percent gain was about 15.3% back in 1933, the largest daily gain. The largest single day point loss in the Dow was about 29.97 in March of 2020 when all those COVID shutdowns started to be announced, which was a 12.9% daily loss. Historically, the worst daily loss in the Dow was about 22.6% back in 1987. And that same 22% loss today would be over 10,000 points. So, what's the story with all this data, Tracy? Break it down for us.
Yeah, and of course, numbers are all relative as well.
Hmm.
A 22% loss, I think you just said, would be worth over 10,000 points
Yeah.
in the Dow today.
Yep.
I mean, that'd be catastrophic,
Yeah.
right? So it's all relative, but volatility is, of course, the name of the game. And investing in the market, and many of our, listeners have invested over many years or many decades, right? And we all know that there's shares of ups and downs. However, over the long term, that's when investing really pays off. And again, why people, invest money in markets instead of putting money under the mattress for that growth. So like to throw a couple other statistics that always resonate, at least with me. If we think about the stock market, you go into a today in the stock market, whatever day, we're recording this, whatever day the viewers are listening to this, there's a 54% chance that the stock market will be positive today.
Mhm.
Historically, over the past about 100 years, 54% of trading days using the S&P 500 index as sort of our target there have been positive. So just a smidge over, half of the experiences, right? But then if we elongate it to an annual basis, so how many years has the S&P 500 been positive really over about the past 100 years that they've been really keeping statistics? It's about every 3 out of 4 years. It's 73% to be precise,
Wow.
since the 1920s have been positive years in the stock markets. So again, we know the stock markets go up, we know they go down, and thankfully the statistics prove that they go up more than they go down. And, same approach that we've been preaching for a long time. The key is to stay the course and not try to time the market, right? It's just proved to be a fool's errand over the years for those people who try to time the stock market.
Yeah, great stuff, Tracy. I tell long-term investors all the time, you got to take the good with the bad,
Yeah.
right? Know that historically the good, as you just mentioned, always outweighs the bad, and that's really what we're looking for. But you have to have that discipline again to withstand those down years and not do anything drastic within your account. So really, really good information. So we did mention, I think Tracy said earlier, we do have a bonus nugget for you here today. And I guess we'll call this one, It's Never Too Late, The Wealth of Warren Buffett. So
Mm.
this bonus one is quite staggering, and I certainly find it to be inspirational. And it is, did you realize, Tracy, that over 99% of Warren Buffett's wealth, which is pretty massive,
Yeah.
happened after the age of 50?
Yeah, that is pretty impressive, isn't it? If you
Crazy.
really think about it.
Yeah.
And, I think about, Brian, both you and I recently crossed that 50-year-old milestone. So perhaps it's not too late for us to amass a fortune as well. What do you think?
Are you age shaming me now, Tracy? You have to put that.
Maybe a little bit.
It's
You
okay.
are you're older than I am after all.
Yeah,
So
right. Well, come
there
a
we
little
go.
closer to retirement. We'll take it. Yeah.
But, if we think about what does this stat tell us, that really time and compounding do work if you're patient and old enough, right? If we think about it. So again, building wealth is, I always akin to it. It's sort of like a slow cooker. Nothing seems to happen. When I put stuff in a slow cooker, you keep looking and every 5, 10 minutes opening up and seeing what's going on. Nothing seems to happen for hours. And then all of a sudden it's time for dinner. So wealth is a lot like that slow cooker.
Love it. Love it. All right, everybody, as we wrap up today, let's talk about some action items as we always do. So, in the statistics we covered today, that hopefully you enjoyed, we worked in some fundamental financial and investment concepts that we've been preaching for some time now, Tracy. And can you just briefly recap those with our listeners?
Absolutely. So diversification, we talk about that a lot. Dollar cost averaging into portfolios. And again, just to explain that, that's what most people do in your 401ks. You're putting some in every paycheck, right? That's what we call dollar cost averaging.
Hmm.
Focusing on cost, low cost investments, focusing on the long term. Living within your means when you're spending, and you're not trying to keep up with the Joneses or your neighbors or so forth like that. And then some equities, having equity exposure to combat inflation, not timing the stock market, and the patience and discipline. We talked about that a few times here today, and just having that throughout it. So all of those items that we just talked through, those are things we can control, right? So it's so important to focus on what we can control and sort of ignore things that are outside of our control.
Well said, Tracy. Absolutely. All great concepts to remember. So we will wrap up for today. I can't believe, again, it's been a full year. I've had a
Yeah,
great time, Tracy, on this podcast with you.
same
Looking
here.
forward to more episodes next year. But I want to remind our loyal listeners, again, thanks so much for tuning in to these podcasts. But reach out to us with any questions or comments you have. You can hit us up at podcast@conradsiegel.com. As always, we are here to help. We are eager to help. And remember to share this podcast with your friends, family members, coworkers. And if you're so inclined, give us a 5-star review and certainly subscribe if you haven't already. Happy New Year, everybody. Take care.
Thank you for tuning into today's show. The Real Talk Retirement Show is created and produced by Conrad Siegel, an advisory firm that specializes in helping people prepare for retirement and beyond. If you want to learn more about our work or meet the team, you can visit conradsiegel.com. Information on this show is for educational purposes only and should not be considered personalized investment, tax, or legal advice. Before making decisions, you should consult with the appropriate professionals for advice that is specific to your situation.